Hello and welcome to IG's Trading the Markets podcast, where we discuss some of the pressing market issues of the day and to help give you a steer on where the trading opportunities arise. Today joining us is Nick Cawley, analyst at Daily FX. Nick, in a moment we'll pick up on the implications of the latest news on the US-China trade war. But first of all, the European Central Bank has released its Financial Stability Review or report today that highlights the issues facing the Eurozone, and it makes us some worrying reading. What are the headlines as you see them? Looking at it, I mean, they've again reiterated that there are sort of downside risks to global and euro area growth, which I think we all understand, we all know, we can see that in the hard data that's around. They said that the low interest rate environment that is currently going on and the new QE package it's just started, is supporting the economy. But I think what they also did highlight, and I think this is where perhaps we should look at the sort of the risk element of things, is that some of these non-banks, or I think they call it the shadow banking sector, have been encouraged to take excessive risk taking. And when central banks start talking about excessive risk taking, I think you should sit up and take notice. What's the significance of this shadow banking sector? Because I thought the European Central Bank, and I'm not just talking about the ECB and the euro area, the Financial Services Authorities, of course, it then was in 2009, now the FCA, the Financial Conduct Authority, and the SEC in the States. I thought those bodies, including the ECB, had tried to regulate out the problems that the banking sector has, these issues, the risks that they face, stopping them taking the risks.
Yes, I think what we have here is that the regulations perhaps are not as strict on these shadow banking institutions, right, non-financial institutions. And where the problem comes, where the ECB is highlighting this excessive risk-taking, is that the knock-on effect that, say, a sudden repricing of assets due to some of the non-financial banks and institutions will have a much wider knock-on effect into the banking system. And this is where, these knock-on effects, these ripple effects, they get bigger. And this is where risks to markets occur.
Yeah, I've been looking this morning at some of the equity implications for this. I'm witnessing declines in some of the banking stocks. We know the inherent problems that are caused in the banking sector, especially for the big ones like Deutsche Bank especially. From your side of the desk, I know you deal in some of the other markets. What do you see as the trading opportunities out of this, away from the banking sector, where, as I say, the short positions are winning out today? What other areas of the markets are we looking for here for opportunities to trade?
I think you have to have an idea of risk and what your perception of risk is in the market. Myself, I'm slightly more pessimistic about the market at the moment. I think that there's that the risks that are around haven't been fully priced into the market. We've seen global equity markets at or near all-time highs, fueled by this sort of very loose monetary policy, global monetary policy that we have at the moment, cash sloshing around, needing a home. And the real problem, I think, is that if this does have a repricing of some sorts, then you should really be looking at risk-off assets, that you should be looking at assets like gold, the Swiss franc, the Japanese yen, areas of calm in a storm, as it were.
Yeah. What implications does this have for the euro?
I think the euro is still inherently weak. I mean, we look at the euro on a daily basis against a wide range of currencies, and it's very difficult to pinpoint any reasons to buy the euro. You may see opportunities to buy it in the short term, like, for example, on Friday, we have the latest look at German, French, and Eurozone PMIs. It's always a little pinch point of market activity. They may come in slightly better than expected, but they're still at very lowly levels anyhow. So you may have a very short-term rally in the euro, but you're not talking about big figures. And so I see, going forward, the euro is still inherently weak, and I can't really see any reason to buy it with any confidence.
It's interesting, actually, Nick. We were talking off air just before we went into this, and round the table here between you and me, we've got more than 60 years experience of either trading or reporting in the markets. And I'm pretty sure I can speak
for you as well on this. We've never really seen anything like this. The European Central Bank, I mean, of course, it's only been with us, 20 years anyway, but negative interest rates.
Yep.
You know, this is unusual territory. We've got a new chief coming in, Christine Lagarde from ECB. She's brought in a new economist, chief economist. Should we see any change in direction that we have seen from the ECB the last 10 years with Mario Draghi as it transfers over to Lagarde?
I think we will do. I think that Christine Lagarde's coming in. ECB monetary policy is kind of running out of effectiveness. I know that sounds quite wishy-washy, but it is running out of effectiveness.
It's a drug user thing, isn't it? You know, getting used to the drugs. You've got to have something else.
You're not getting as much bang for your buck, or whatever the expression is.
Yeah.
So I think what's going to happen is, and Christine Lagarde speaks on Friday, I believe. It's her maiden speech for ECB as ECB president, and she will, I believe, be looking at putting growth back into the hands of EU member states. And so basically it's going to be more of a fiscal push than a monetary push. Because as I said, the ECB is kind of running out of bullets. I mean, if you look at Japan for the last 15, 20 years, negative rates, as much money flowing around, they're buying bonds, they're buying equities. It hasn't worked. And so I think what needs to be happening, and I think this is where Christine Lagarde will make her mark, is that she will promote a fiscal push.
So that is tax cuts from government,
yes,
as opposed to monetary policy. Okay, let's move on and take a look at the other thing that's occupying our minds today, and this US-China trade spat. Do we call it a spat, or is it a trade war? I'm never quite sure how to report on this.
I think spat's good.
Yeah, I think spat's a good word. Anyway, look, President Trump has threatened to raise tariffs if Beijing fails to go for a deal. Is this just brinkmanship, or is there anything serious about this? I mean, I've got one eye on Trump's second term, so at some point he's got to get a conclusion to this.
Yes, he's not making it easy for himself, that's for sure. I mean, and his Twitter account really is one of those things that people sometimes just sigh and despair at when he comes out with his latest proclamations or whatever. I think what actually happened yesterday is that the US Senate passed this new bill, this Hong Kong Human Rights and Democracy Act, and I think this has added fuel to the fire between US and China. China's basically saying, don't interfere in our internal politics. The US, as I said, it's gone through Senate, it'll need to go through Congress and then be signed off by Trump. This will give them the ability to relook at the special relationship that Hong Kong has, economic relationship, and to impose or sanction either people or companies if they feel that they are blocking the human rights in Hong Kong. And so this is another. It's like a grenade being thrown. As I said, it's fuel on the fire. You can understand why he's doing it. Yes, because the protests have got particularly violent. But it's not going to help any kind of trade deal. And Trump's also been saying that it's my deal. Here's the deal. If you don't like it, I'm going to raise tariffs. I think was it Wilbur Ross is trying to be more placatory and saying that yes, we can get this phase one deal reached, but we wonder, and at the 15th of December, there's I think another 156 billion of Chinese imports. Right. And there'll be 15% tariffs put on it if nothing is reached.
And of course, the thing is, I guess the ECB's got one eye on this as well. When you're talking about the future growth potential or otherwise in the Eurozone, clearly they want to see some sort of end brought to this. And of course, Trump veering away as well from imposing some sort of tariffs on European companies, as though, which is another thing which maybe we talk on another day. Just briefly talking about trading opportunities, you were talking about the appeal of some of the risk-off assets like gold and so forth. I guess the same can be said here for what's happening around the Hong Kong issue, US-China trade talks and so forth. Anything else you're watching out in terms of opportunities to trade the markets around this area?
I think at the moment it's very difficult. As I said, I think because risk has been underpriced in the market, that's my belief, that risk is still underpriced in the market. I wouldn't like to get into equity markets at the moment. I mean, I know it sounds very negative, but I don't mind missing a 5% uptick if there's going to be a 15%
Downside.
Revaluation of markets.
Good word, revaluation. Good word.
So, I mean, I would still look at assets like, as I said, gold, Japanese yen, Swiss francs, just traditional safe assets. I mean, you may not even see any price appreciation or only marginal price appreciation over the next few weeks, but what I think you're doing is you're steering away from potential heavy losses.
Yeah. Okay. All right, Nick. Look, thanks. That's another 10 minutes, by the way, added onto our total list of years that we've covered the markets. But Nick, thanks indeed for your time. As Nick was taking part there in today's IG Trading the Markets podcast, Nick Cawley is an analyst at Daily FX.